Bill Simon had bought a company, Gibson Greeting Cards. He invested only $330,000 of his own money and made $70 million in 18 months. And I had read that you didn't even know what a leverage buyout was, but it was better than practicing law. By the way, I hated practicing law. I love Northwestern, I love Chicago, but I hated law school. For me, I always knew I wanted to go into business. Can you tell us more about starting the Carlyle Group and getting into a business, doing something you knew absolutely nothing about?
Well, what actually happened was I was practicing law, doing whatever I could get to practice law. I was a partner in a medium-sized firm. I wasn't famous. I didn't think I wasn't really going to go back in the White House. And I had an opportunity to maybe go work in the campaign for Mondale when he was running in 1984. But I said, geez, I don't know if I really want to do this again. And I just didn't think I wanted to go back in government and kind of start this whole thing over again. And Mondale wasn't sure he was likely to win anyway. So when 1986 and 87 came along, I read about Bill Simon. I also read that an entrepreneur will start his or her first company between the age of 28 and 37. And after 37, like a woman's biological time clock goes down, your chance of reproducing goes down. Your chance of starting a company after 37, I read, goes down. And I was then 37. So I talked to some friends of mine and said, maybe I should do something like Bill Simon had done. And of course, they said, well, you don't know anything about that. And I said, yes, but I'll recruit some people. And eventually I interviewed a number of people who had finance backgrounds and said, we'll start the first buyout firm in Washington. Some people were interested, but it didn't really click. And then when all of a sudden, one of my clients, head of taxes at Marriott, said he decided he was going to start this firm and he found the person to start it with. I said, great. Who is it? And he said, you. I quit my job today and I'm going to come and you're going to start with me and we'll do it together. I said, but I don't know anything about finance and I'm really a lawyer. He said, that's okay. So he kind of worked out of a conference room near my office. And then we recruited two other people, Bill Conway, who was at MCI, and Dan Daniello, who was then at Marriott. And the four of us started. And then somebody who was a friend of mine, Ed Mathias from T. Rowe Price, helped us raise the initial $5 million in 1987. That's all we had, $5 million, $3 million to invest and $2 million to operate. And that was the beginning.
Dan and Bill didn't want to raise any money. That was your job, which you did for 25 years. So T. Rowe Price, they helped you raise the $5 million. Where did it come from? Without a track record, wasn't it very hard to raise money?
It was, but Ed Mathias had a reputation at being a good spotter of talent. And so he went to four people and they put up the money. One was his firm, T. Rowe Price. They put up $1.25 million. The Mellon family put up $1.25 million. Then the Alex Brown, also in Baltimore, put up $1.25 million. And the First Interstate Bank in California put up $1.25 million. These are all friends of Ed's. And so he had $5 million. Now, nobody really thought we were going to get much done, but people were willing to take a chance. Now, you have to remember, this was 1987. There weren't a lot of private equity firms in those days. There weren't any big behemoths like Blackstone or KKR or Carlyle or Apollo are today. But people were willing to take a venture kind of chance, and there wasn't that much money. So ultimately, we began starting investing, and we did okay. And so one thing led to another.
Let's talk about the beginning years of Carlyle when you first got going. You did have a tough start. You struggled in the first several years. You bought an airline food company called Cater Air, and you lost a bid to buy the restaurant chain Chi-Chi's. But after several years, things turned around. You hired former Defense Secretary Frank Carlucci as your vice chairman. And through his relationships, you bought a defense consultancy company called BDM from Ford for $130 million, a company which Ford had purchased for $390 million only 2 years before. And you later sold it for a huge profit. It's not uncommon to struggle when you start a new business. When you do, you have a lot of self-doubt and sometimes think, what on earth have I done here? As we think about our pursuit of excellence, we need to overcome our challenges. Can you tell us more about your struggles at the beginning and how you beat the struggles? You started with $5 million and now you built one of the most successful investment firms in the world, which manages $275 billion in assets.
Well, our deals, some in the early days weren't all that successful, but then we had, as you point out, BDM, which was successful. And then we had former Secretary of Defense Frank Carlucci, and then he was a well-known figure, and so he could get his calls returned, and that was helpful in raising money. 4 years later, Jim Baker was leaving government as former Secretary of State and former Secretary of Treasury, and we recruited him, and that began to give us some credibility. we'd only had, when I was recruiting Jim Baker, we only had about $100 million under management. And we were then going to try to raise a bigger fund. And he gave us credibility because we didn't have that much then. In the end, our deals were modest in size, but they generally worked out reasonably well. They weren't spectacular, but reasonably well. But the reason we grew, to be honest, and the reason we became successful, I think, was that we came up with an idea that doesn't sound very novel today, but it enabled us to kind of transform the private equity world. The private equity world, and the phrase private equity hadn't even been invented yet, and we were called management buyouts or leverage buyouts, was a business where if you were a venture capital firm, that's all you did. And you generally invested in one narrow niche or so, or very narrow area, geographic area as well. Or you were a buyout firm, or you might be a mezzanine firm, or you might be a real estate firm. I came up with the idea that after we raised one of our funds, that we would basically do what Fidelity and Vanguard and T. Rowe Price had done, have multiple funds in different areas of private equity, and then use our brand name to kind of sell the fund. So if we were good in buyouts, I would say to somebody, give us a chance in growth capital. If we did well for somebody in buyouts and growth capital, I'd say, give us a chance in venture capital. And that's how one thing led to another. And then I decided to globalize it, which is to say, raise funds in Europe and Asia, Japan, around the world. So what we did is we institutionalized the business by making it more than just a mom and pop one fund thing. We had multiple funds, and then we globalized it. And that led to really what others have done as well. Blackstone, KKR, Apollo, a number of other firms have built these multidiscipline global firms. And that's, what enabled us to do what we did. But my partners who did the investing, I wasn't doing the day-to-day investing. If the track record had been bad, my running around the world begging for money would not have worked.
You're a great investor. All investors make a lot of mistakes. And I want to talk about 3 of your mistakes. When your daughter was at Harvard, she met a classmate named Evan Racklin, who's now her husband, who wanted to introduce you to his classmate, a guy named Mark Zuckerberg. We all know the story. Mark dropped out of Harvard and started a company, and he was looking for money. When Evan described it to you, thought it sounded like a dating service for college students, and told Evan that it would never get anywhere, and you declined a meeting with Mark. I'm guessing you would have probably invested more than this, but had you invested $30,000 back then, it would have been worth around $20 billion today. That's one mistake. Then in the early years of Amazon, you passed on the opportunity to take a 20% stake in the company. You told Jeff Bezos that if he got lucky and things worked out, he would at most be worth $300 million. You ultimately made a small investment, didn't have confidence in the company. You ultimately sold your stake for $80 million. Just to put a little bit of numbers on this, on June 30th, 1998, your stock closed at $16.62 per share, and it had a market cap of $834 million today. It's trading at around $3,700 a share and has a $1.82 trillion market cap. That's an increase of 2,064 times. If you had kept your stock there, it would now probably be worth over $10 billion. You also passed on investing in Netscape, which sold to America Online in November 1998 for $4.2 billion. These are $50 billion misses. Every investor in the world passes on companies that in hindsight they should have invested in. I've been there more than a few times. It doesn't feel that great. It makes me sick at times. And we often talk about regret. What lessons did you learn from these, and how did they help you become a better investor?
Well, I learned I'm not as smart as I thought I was. In those days, the concept of getting a new company off the ground and becoming fabulously successful with it really wasn't that common. There had been venture capital on the West Coast, but there wasn't really a history then of companies becoming worth $1 or $2 trillion. So when I met Jeff Bezos, when he was in his ramshackle initial office building, I remember telling him that I didn't think he could beat Barnes & Noble. They were around a lot longer, and he was explaining to me why he had better knowledge of software and so forth. But I just rolled my eyes. I didn't really believe him. And the same was true when Mark Andreessen showed up at my office trying to explain to us how he was going to navigate the internet. And I said, well, why would anybody want to navigate the internet? And what is the internet? Today, I'm willing to take bigger chances. I have stepped down as the co-CEO of Carlyle a few years ago, and now I'm the co-chairman and a large shareholder. But I also have my own family office. And in that family office, we do a lot of growth capital, venture capital. And there, I've made mistakes again. I keep making mistakes over and over again. Some deals have worked out well, but I had a chance to invest in Rivian. Rivian is this electric truck company. I had a chance to invest in it probably when it was worth maybe under $1 billion. Now I think it's worth 150 billion or something like that. And I turned it down several times along the way. So look, you live and learn, and the best thing you can do is just try to not take it too seriously, and don't jump out of a window because you didn't make an investment. Try to just stay in the game and stay in the arena.
The private equity world typically invest on historical cash flows, so you can generally determine some kind of historical financial performance. There's usually a lot there for you to make some kind of educated investment decision on. The venture capital world, which has been my world for a long time, is there's nothing there. It's a piece of paper. It's a business plan. If you're in the seed round, you're betting on the team. And no one really likes to talk about this, but typical fund, good fund, this is true of ours, 7 to 9 out of every 10 deals go to zero, where you look really stupid and you feel very stupid, but you need the 1 or 2 of 10 to really make up for the other losses that you have. It's a weighted average game.
I put it in, forget to put it in perspective. It's one thing not to make money on a deal. It's different than losing money. When you're losing money, it can be more painful than not making money. Secondly, much more important is your health. If I had done all those deals, but I had terrible health problems and I wasn't going to live that long, would I be better off? I don't know. So the most important thing is to live a happy and healthy life and have a happy and healthy family if you can. And, if you have children, then try to make them as successful as you can and make sure they're happy and healthy. So I don't lose sleep over these investments. I obviously talk about them because I think they're somewhat interesting and humorous, but I don't lose sleep over it. I just wish I was smarter than I had been and had gone into some of these deals.
We've talked about Netscape, which started in April of 1994, 27 years ago, and Amazon, which started 2 months after that in July of 1994, and Facebook, which started 10 years after that in February 2004, 17 years ago. And then there's Bitcoin, which started 5 years after Facebook in January of 2009, 12 years ago. For the first 10 years, almost nobody cared about Bitcoin. And if you went on record to claim it had any value other than to launder money, you were ridiculed by the press, the general public, and some of the most prominent people in the financial world, people like Warren Buffett and Jamie Dimon. But the tide has shifted quite dramatically in the last 2 years, and nobody is saying that now. A little less than 5 years ago, Bitcoin had a market cap of $17 billion, and today has a market cap of $1.2 trillion. You don't invest in individual tokens like Bitcoin itself, but are making investments in companies like Paxos, which facilitates trades of cryptocurrencies. I have 3 questions here. First, why aren't you investing in Bitcoin itself? Second, should the tens of millions of regular retail investors, these are the people buying stocks and mutual funds, invest in Bitcoin and cryptocurrencies? And third, many experts think Bitcoin will replace fiat currencies by 2025. Argentina has done it already. Are they right on this? Is Bitcoin going to replace national currencies?
Well, there are 3 different questions. So first, I don't invest in the Bitcoin or other cryptocurrencies. I honestly don't understand them well enough to do that. I'm not a currency expert, and I realize there's a lot of speculation going on. So I've concluded through my family office that I'll invest in companies that service this industry, which I think is going to grow and continue to grow. It's a somewhat safer way to play the industry. It may not produce the exponential returns of investing in Bitcoin at a low price or another new cryptocurrency, but it's a little bit safer, I think, at least from what I'm interested in doing. I do think that if you want to invest in Bitcoin or cryptocurrencies, I don't think you're a terrible person for doing that. I just think you should recognize that it's going to fluctuate dramatically, and you could lose a lot of money. You can make a lot of money. It's like I analogize it to going to Las Vegas. I'm not a gambler, but most people go to Las Vegas and gamble. They know they're going to lose money intellectually. Now, if they win some money, all of a sudden they think they're a genius and they put their money back. If not on that trip, the next trip they'll put it back. So in the end, I think people should go to Las Vegas and gamble if they enjoy it, but do it with money that they can afford to lose. The same is true in cryptocurrencies. Nobody really knows where they're going to go. And it's late to get in now, I think, and all of a sudden make these exponential returns. But if you like the game of watching every hour and the hour where it's going, and it's like gambling for you, and it's speculation and it's fun, put in the amount of money they can afford to lose, and you'll maybe have an enjoyable time. I do think that these currencies are too now ingrained in our global financial system to say they're gone. It's like prohibition. We decided we didn't really want to let people drink alcohol. It wasn't good, people thought. So we had prohibition. It didn't work. The same is true here. You're not going to be able to stop people who who think that the dollar is going to be overly inflated. We won't be the reserve currency in the world in 25 years or so, and that there's other things they want to do analogous to what gold used to be. And that's what some people see these current currencies as. I don't think there's anything wrong with that. I just wouldn't put too much of one's money into it unless you're really, really an expert. I am, doing an interview of somebody that's got billions of dollars in Bitcoin, and he got there early and made a big bet, and congratulations to him. Who knows whether it's going to be worth that in a year or two? I think the government is going to try to regulate this at some point, but I doubt if government will be successfully able to eliminate it. China is trying to eliminate it, but I think it's going to be just offshore, and Chinese people interested in it will just invest offshore in these kind of things. So it's an interesting concept that people can create out of whole currency and out of whole cloth, these currencies, but it seems to be meeting a need.
Will it replace national currencies in many countries? I can't see it replacing the currency of the United States, but it's what about some of the other smaller, more third world countries or countries that have a very unstable economy with very high inflation?
Governments regulate currency and issue currency because it gives them some control over the economy and enables them to make decisions that theoretically are better for people. I suspect that most economies will continue to have their own currency, but they may all go in time, in your lifetime and maybe mine, to digital currencies. There's no reason why we need to have paper currency really much anymore. We can have it, but a lot of it's used for illicit purposes. The most common printed bill is the $100 bill, and it's often used. And I think we ship more of those offshore than we actually use them in the United States. So I think that you'll always have governments with controlling currency, but I think it'll be in the future a digital currency. The United States is working on a digital currency now, and at some point, I suspect 10 years from now, we won't have paper currency. We'll just have everything will be digital. So it's not the same as a cryptocurrency, which is a little bit of an outlaw kind of thing compared to what a government does. But I do think that you're not likely to see cryptocurrencies replacing government issued currencies, in my view.
We've talked about the beginning of the internet and social networks and Bitcoin. Now let's talk about non-fungible tokens, or NFTs as they're known. For our listeners and viewers who don't know what an NFT is, they're a blockchain-based tool that enables anyone to monetize digital content. You can create an NFT of a collectible, such as a unique artwork. On May 11th of this year, an NFT that is considered the Mona Lisa of the art world sold for $69 million. In October of last year, the first pair of cyber sneakers sold for $90,000. In October of this year, somebody paid $1.5 million for 9 plots of virtual real estate. And then there's the sports world. Last year, the NBA created something called Top Shop. It's an NFT marketplace where fans can buy, sell, and trade NBA moments, which are packaged highlight clips that operate like trading cards. In April of this year, a fan bought a LeBron James NFT dunk for nearly $400,000. Most people don't know this, but the first non-fungible token was created in 2012. Similar to Bitcoin, they took nearly a decade to gain a lot of steam. And at one point, they also seemed like a passing craze. But similar way, nobody's saying that anymore. The emerging technology is growing. It's a major industry now. In the third quarter of this year alone, there are more than 10 billion in non-fungible tokens traded, which is up more than 800%, 8 times from the previous quarter. What do you think about non-fungible tokens, and are you buying them?
Again, I'm not an expert in it, but my family office has studied it, and we will be making investments in that area. Probably not so much in the tokens themselves, but around companies that service the industry or that have some ability to kind of help different people that are trying to get into the industry. Well, when you think about it, let's suppose you own a work of art that's a great work of art. Why do you have it? Well, it's beautiful. You can do that on a token as well. You can look at it and say it's still beautiful. You can show it off to your friends. Well, you can do that with a non-fungible token as well. And you can sell it. And presumably you can do that with a non-fungible token. So when you buy a painting, what are you getting that you're not getting for the non-fungible token? Well, you can argue it's more permanent or something, and there's a longer history of those kind of things. But I think it's a mistake to think that this is a passing fad. And I think 10, 20 years from now, people will say, who were the idiots that didn't think that non-fungible tokens were going to work?
It's amazing the speed at which The market is growing. We're seeing a lot of deals in this space, and there's just tremendous amount of money going into billions and billions of dollars on the investment front as well. It's going to be fun to see how this all shapes out.
Another area, like take esports, for example. I don't, you're familiar with that. I've invested in, for my family office, in a lot of esports related things. I never even heard of it until someone called me a few years ago about it. And all of a sudden it turns out that there are, staggering numbers of people that are watching esports, playing esports, and, making money investing in it. I wish I knew what the next concept was going to be, like the non-fungible token or the Bitcoin, so I could get there before everybody else gets in. But I try to find these things, but you never know exactly what's going to take off.